Trading Options 101, the basics. We always appreciate the support for our content and channel to grow. So if you made it this far and enjoy using our content to grasp learning options and taking control of your finances and investments, please like, comment, share, and subscribe. We have discussed the return on investment scenarios for buying call options in part 3. Since that's only the buy side return on investment, in this video we'll show the sell side return on investment to give you a full picture comparison of the buy side return on investment versus the sell side return on investment for call options. Short selling covered calls. Now let's break down scenarios for short selling a call option. Instead of buying a call option, since an investor can choose to sell or write a call option too, there are 2 ways this can be done: naked call options and covered call options. Note for covered options: risk is managed, not eliminated. While covered calls and covered puts reduce risk somewhat, they cannot eliminate it entirely. With that in mind, here are a few cautionary points about these strategies. You will have limited profits. Covered options usually prevent significant profit potential if a stock moves substantially in your favor. Anytime you sell a covered option, you have established a minimum buying price, covered put, or maximum selling price, covered call, for your stock. Any stock movement beyond that established price creates no additional profit for you. Losses reduced only somewhat. Because losses are reduced only by the amount of its premium you received on the initial sale of the option, in addition, it's rarely a good idea to sell a covered option if your stock position is already moved significantly against you. Doing so could cause you to establish a closing price that ensures a loss. So before you sell, ask yourself, would I be happy if I had to close out my stock position at the strike price on this option? If you can answer yes, you'll probably be okay. If you hold until expiration. While our examples assume that you hold the covered position until expiration, you can usually close out a covered option at any time by buying it to close at the current market price. Regardless of whether the equity part of your strategy is profitable or not, waiting until expiration will maximize your return on an out-of-the-money option. However, you are not required to do so. Assignment. A significant change in the price of the underlying stock prior to expiration could result in an early assignment. And if your short option is in the money, you could be assigned at any time. Covered calls written against dividend-paying stocks are especially vulnerable to an early assignment. Corporate events. When companies issue a corporate action, merge, spin-off, split, acquisitions, rights issues, pay special dividends, etc., their options can become very complicated. Since it's doing something that will affect its stock price, you need to understand how each corporate action will affect the company's stock. Moreover, a corporate action can also tell you a great deal about a company's financial health and its short-term future. Thus, to sum up our cautionary points about each of these strategies, just remember, risk is managed, not eliminated. It's very important to discuss risk when talking about naked and covered calls. Again, let's actually break down some short selling call option scenarios. From the seller's perspective, there are 3 outcomes of selling a call option: taking a loss, breaking even, and making a profit. In order to explain these outcomes, we will evaluate 5 different scenarios using the return on the sale of a call option formula. Let's assume that an investor purchases 100 shares of an underlying asset at a market price of $100 per share for a portfolio value of $10,000. The investor decides to sell a call option at a strike price of $110 and an option price of $5. Since call option contracts include 100 shares, the total price of the call option is $500. $5 multiplied by 100 shares. If we assume that there is always a buyer, the seller will earn $500 in premiums when they sell the call option contract. First scenario, Seller has a loss, selling a covered call option. The price of the underlying asset decreases to $93 per share. The buyer decides not to exercise the call option because the value of the underlying asset is below the strike price. In this case, the seller will lose $700 due to the decrease in the price of the asset. The $7 decrease multiplied by 100 shares. But since they earned $500 from the sale of the call option, they would take a net loss of $200, $500 minus $700. The value of the portfolio would decrease to $9,800, and the return on investment would be calculated as follows. A loss of $700 from an option contract that's earned $500 from premiums is negative $700, plus your $500 premium received, that's negative $200, divided by $10,000. Your portfolio value, which equals a negative loss of 0.02, multiplied by 100 shares, equals a negative 2% return on investment. Thus, the seller of the call option will lose 2% on their investment. Second scenario, seller breaks even, selling a covered call option. The price of the underlying asset decreases to $95 per share. The buyer decides not to exercise the call option because the value of the underlying asset is below the strike price. In this case, the seller will lose $500 due to the decrease in the price of the asset. The $5 decrease multiplied by 100 shares. But since they earned $500 from the sale of the call option, they would break even. Since they neither gained nor lost money, the value of the portfolio would remain at $10,000, and the return on investment would be calculated as follows. A loss of $500 from an option contract that's earned $500 from premiums is negative $500, plus your $500 premium received. That's $0 divided by $10,000. Your portfolio value, which equals 0 multiplied by 100 shares, equals 0% return on investment. Thus, the seller of the call option will neither lose nor gain money on their investment, called breaking even, also known as the break-even point. Third scenario, seller makes a small profit, selling a covered call option. The price of the underlying asset remains at $100 per share. The buyer decides not to exercise the call option because the value of the underlying asset is below the strike price. In this case, the value of the underlying investment would not change, and since they earned $500 from the sale of the call option, they will make a profit. The value of the portfolio would increase to $10,500, and the return on investment would be calculated as follows. When you earn $0 from an option contract that's earned $500 from premiums is $0 plus your $500 premium received. That's $500 divided by $10,000. Your portfolio value, which equals a positive gain of 0.05, multiplied by 100 shares, equals a positive 5% return on investment. Thus, the seller of the call option will earn 5% on their investment. Fourth scenario, seller makes a large profit, selling a covered call option. The price of the underlying asset increases to $130 per share. The buyer decides to exercise the call option and purchase the seller's shares. In this case, the seller would earn $3,000, the $30 increase in price multiplied by 100 shares, and an additional $500 from the sale of the call option. They will make a profit of $3,500. The value of the portfolio would increase to $13,500, and the return on investment will be calculated as follows. When you earn $3,000 from an option contract that's earned $500 from premiums is positive $3,000, plus your $500 premium received. That's $3,500 divided by $10,000. Your portfolio value, which equals a positive gain of 0.35, multiplied by 100 shares, equals a positive 35% return on investment. Thus, the seller of the call option will earn 35% on their investment. Disclaimer: before we dive deeper into naked call options, please understand these examples are based on past performances and experiences. Furthermore, they are not indicative of future results. These videos are for educational and entertainment purposes only. Any content used for our videos should not be construed as financial advice or a recommendation to buy or sell any sort of security or investment. Naked calls are high-level advanced trading strategies that are very risky. But remember, more risk equals more money. Please make sure you have the skills, knowledge, and portfolio position sizing, as well as leverage to handle placing these types of trades. Naked call option definition. These are extremely risky, and you must fully understand the risk of these positions, which is why we are focusing on educating people about the risk of naked options, but also learning how you can manage that risk while making more money. A naked call option is a strategy that involves selling a call option without owning the underlying shares. In this situation, the seller receives premiums from the buyer in exchange for the right to buy a fixed amount of the underlying shares at a set price on a specific date. If the buyer decides to exercise the option, the seller must purchase the underlying shares at market price, then sell them to the buyer at the strike price. The maximum profit in this situation is the amount earned from the premiums, but the maximum loss is unlimited because the market price of the underlying shares could increase indefinitely. If the market price is higher than the strike price, the seller must buy the shares at the higher price and sell them to the buyer for the lower price. Fifth scenario, seller doesn't own the underlying asset, selling a naked call option. In this situation, let's assume that the buyer did not originally purchase the underlying asset for $100, so they are now selling a naked call option. Using the same numbers as the previous situation, the price of the underlying asset increases to $130. The buyer decides to exercise the call option to purchase 100 shares of the underlying asset. Since the seller does not own any of the underlying shares, they must now purchase 100 shares at $130 for a total of $13,000 and then sell them to the buyer at $110 for a total of $11,000, generating a loss of $2,000. The value of the investor's portfolio will be negative $1,500, a $2,000 loss on investment plus $500 from the sale of the call option, and the return on the investment would be calculated as follows. A loss of $2,000 from an option contract that's earned $500 from premiums is negative $2,000, plus your $500 premium received. That's negative $1,500 divided by $10,000, your portfolio value, which equals a negative loss of 0.15 multiplied by 100 shares equals a negative 15% return on investment. Thus, the seller of the call option will lose 15% on their investment. The bottom line about naked options is trading naked options can be attractive when considering the number of potential winning trades versus losing trades. However, do not be taken in by the lure of easy money because there is no such thing. There is a tremendous amount of risk exposure when trading in this manner. The risk often outweighs the reward. Certainly, there is potential for profit in naked options, and there are many successful traders doing it. But make sure you have a sound money management strategy and a thorough knowledge of the risk before you consider writing naked options. If you are new to options trading or are a smaller trader, you should probably stay away from naked options until you have gained experience and capitalization. Okay, I see the benefits of options. However, I can still lose money. So how do I beat the market? Well, the answer to that, join our trading education group community now. Mo Investments gives you the edge that will allow you to be more consistent and way more profitable. We have numerous members using technical analysis as well as technical indicators like implied volatility rank, PNF charts, and candlestick charting, etc. Plus, we will give you an additional leg up using algorithmic trading bots, also known as algo and AI bots. to analyze which direction the stocks are moving to stack the deck of high probability trades and consistent income from producing more profitable trades. In addition to real-time trade alerts about profitable trades, and if you can take immediate action, then you can execute the same profitable trades. 2. Beat the market by knowing what side of the trade to play, also known as the winning side. Good strikes, entry and exit prices, also known as marks, etc. While most traders are trading with one leg, you'll be trading with numerous legs for way more consistent trades and profits. This is how numerous Wall Street moguls and hedge funds, also known as hedgies, beat the market. They share, outsource, and convert trading plays, ideas, strategies, etc. We realized that from being on Wall Street, as well as working in investment and commercial banking. We needed to find strategies that didn't rely on the precise timing of position entries and exits. We needed strategies where you could still win on trades even when the stock didn't do exactly what you predicted. You can't wait to continually rely on hope to generate a profit. So we made the switch to options and started consistently winning on our trades. Plus, if you have had success beating the market by trading stocks, predicting a nice move either up or down, then you already have the confidence and skills to make money in the stock market by identifying good stocks poised to make big moves. Now, if you add the consistency of those trades to the options market, you'll get more bang for your buck, or reap the rewards, fruits of your labor for correctly predicting price movements. With Mo Investments, you are easily racing with at least 2 legs, while other traders are racing with 1 leg, or no legs, because they lack the resources or knowledge. Mo Investments members are executing trades faster and profiting more gains faster, and so forth. Currently, we have a 90% overall win rate, because with our option trades, we implement numerous and diversified strategies for any trader in any portfolio size. We execute profitable day trades, swing trades that are bullish, bearish, and neutral spreads, where the price of the stock can fluctuate up or down, and we can still profit. We cater to all investors, whether you're looking for conservative, moderate, or aggressive growth, or need an expert stock picker. We have numerous profitable trades and plays for you, in addition to exclusive access to our long-term investment portfolio, Stock Gains, for those long-term investors in need of insight and guidance with excellent stock picks where you can park your money comfortably and secure solid long-term gains. Our exclusive membership will allow you access plus an exclusive peek into our portfolio where you can see all the trades we execute for a huge, unmatched, and leg up on trades to have much higher and more consistent gains and profits. When members can mirror trades from trading gurus using their expertise to enter highly profitable and successful trades, it saves them so much time, effort, and energy when learning, or if they're too busy themselves to commit full time the necessary hours to help them match our success or achieve the same success as other members in our trading community. In conclusion, options are important because they offer investors more flexibility in their investment strategies and allow them to get involved in the stock market without directly purchasing shares. They can help reduce risk, increase returns, and provide leverage. Trust that our strategies and guides for our content have been back-tested several times over at least 1 to 2 years with over a 98% success rate. So please follow our content and the process entirely and thoroughly. If you follow and stay dedicated to our educational guidance, you will be highly successful. It's our Better Trader guarantee. Visit us at moinvestments.org and sign up to join our trading community now. Become an elite trader, earn consistent income, and build your generational wealth executing profitable options trades. Stay tuned for more Trading Academy content. We can't wait to see you in the next video. And don't forget, please like, comment, share, and subscribe. To join, just go to moinvestments.org/collections/all for membership offers and info about how to sign up to start your investment journey now. Follow us at Mo Investments on all social media platforms to see profitable trades, investment insight, profit performance postings, as well as free giveaways. Video disclaimer: Mo Investments is for educational purposes only. We do not force any investments or trades, and you are to use your own due diligence when investing or trading. Results are not guaranteed. Past experiences are not indicative of future results. Always invest and trade with an amount that you are comfortable with losing and that you will not jeopardize yours or someone else's financial well-being. Mo Investments is not a financial or investment firm, and all signals are to be used knowing they may or may not be accurate. These videos are for educational and entertainment purposes only. Any content used for our videos should not be construed as financial advice or any recommendation to buy or sell any sort of security or investment. Please consult a professional financial advisor before making any financial decisions. Investing in general and options trading especially is risky without proper research, knowledge, and due diligence.